Dennis, I just want to pick up on what you just said, which is, when you have a change in monetary policy, it seems as though things continue to essentially move in that direction, perhaps longer and steeper than people believe. But, for the past decade or so, since quantitative easing, we have seen so many different movements, where you do think it was 2018, right? December of 2018, where we had a big drop in the market because of a misstep. In other words, they can continue to walk these comments back. So why would it be different this time?
I think that we have to pay attention to the fact that when the Fed began to ease several years ago, the overnight Fed funds rate to the zero bound and kept it at the zero bound for years. Nobody anticipated that. Nobody expected that. And yet that's where we went. Now we've gone from the zero bound. We've got the overnight Fed funds rate up in the fours. We're probably going to go to the fives. And I think Mr. Powell wanted to make it abundantly clear yesterday when he spoke that anybody who thinks that the Fed is going to ease monetary policy soon and cut the overnight Fed funds rate rather than increasing it is absolutely dead wrong. I think they're going to continue to fight inflation on a very severe basis. He intends to continue that policy for a long period of time. And it'll probably be 2024, maybe in the middle of 2024, before they stop raising rates and actually let rates go sideways for a period of time. So again, if I've learned anything in 45 years, it's that when the Fed changes policy, it moves rates a lot farther and takes them for a lot longer period of time than the most radical among us want to believe. And I think that's going to be the same process here. They are animals of history, and they tend to repeat themselves.
What do you think will be the implications? How do you want to set yourself up for that? And I know you've got good
I think
trading
you want to
ideas
be.
for us today, but what do you think? Like, even for somebody who doesn't trade or manage their own money, what do you think we need to be bracing ourselves for?
A reduction in housing prices over the course of the next year and a half or 2 years, probably a real decline in housing prices, not as substantive as we saw in 2007, 8, and 9, but nonetheless a decline of probably 5 to 10% in housing prices. I think you're going to see a continued decline in automobile prices. I think you'll end up seeing a decline eventually in most agricultural commodity prices of consequence, but that's off into the future for quite some period of time. But probably the most important thing is housing prices are going to come under pressure. You can't drive the mortgage rate from 3% to 7% without doing, I think, rather substantive damage to housing values over the next year or two.
And how concerned would you be as well about individuals who over levered or thought, I'm going to take out a loan on this house or an extra mortgage so that I can, become a real estate owner of sorts? How
I
much
think you
damage
want
do you
to
think is going
avoid
to be
being
done
a
on the
real estate
personal
owner.
side?
I think if you had the chance to be a renter, you should probably try to rent for the next year or two. I think you want to avoid being an owner for the next year or two. We'll see. Time shall tell if I'm right or wrong. But
Right.
well, that I think is that's to me the driving force behind higher interest rates.
So let's dig into some of the ideas then on the back of where you see the future unfolding. What do we want to own from a tactical perspective right now? I mean, gold, you've been a gold bug. Is that still the case?
I would hesitate to call myself a gold bug because gold bugs believe in the demise of Western civilization, and I don't believe in that. There are times when you should own gold. There
Okay.
are times when you should not own gold, and I think this is one of those times when you need to own gold. Not dramatically, not a huge amount, but I'm like I said, from my own account, I'm long of gold and short of the equities in equal dollar terms, and I'm comfortable with that today. We'll see what happens in the course of the next several weeks, but right now it seems to be working. And if it continues to work
What's the
on a day
case for
like this,
gold?
what's the case for
Yeah.
gold? Geopolitical
Yeah.
circumstances prevailing. That's predominantly it. The one caveat against gold is the fact that the monetary authorities are tightening monetary policy, which should be deleterious to gold prices. But I think the geopolitics of the world are manifestly bullish of the gold market, given the right now. We'll see what happens. The fact that gold got above $1,800, I think, was impressive, and when it gave up a little bit overnight, it came under rather substantive pressure last night, falling what $19 or $20 an ounce, and yet the volume had gone to nothing. So that was, to me, that's impressive. But the bearish circumstances, the monetary authorities being as tight as they are, that's the one thing that I have to be concerned about as I'm bullish of gold. But I wouldn't call myself a gold bug. Again, there are times when you should
Okay.
own gold. There are times when you shouldn't own gold. And I think this is one of those times geopolitically that you should.
Okay. We're going to take, one question. What about oil before we head to break?
Watch the term structure. Watch how the front month of crude oil trades relative to the second, the third, the fourth, the fifth, the sixth month back. And I think on balance, if you ask me where crude oil is going to be in the 6 months to a year from now, I think probably quite a good deal higher, predicated upon China coming out of its shutdown. If you ask me where crude oil is going to be in the course of the next 2 days, 3 days, a week, maybe a bit lower.